separate presentation for the lessor. A lease is a contractual agreement. This means there's a contract that both parties have to sign. It's legal in a court of law. And this is between the lessor, who's the one who owns the equipment or building and is leasing it out, and a lessee, who is the one that is renting and getting to use the equipment or building in exchange for making payments. Okay, so the lessee has the right to use the specific property owned by the lessor for a specified period of time, and that's all listed in that contract or lease agreement. Some of the largest group of leased equipment involves IT equipment, transportation equipment, construction, and agriculture equipment. There are many reasons a company may want to lease rather than purchase equipment. 100% financing at fixed rates. What this is saying is that if you lease something, that's a possibility. You can lease it with no down payment and you'll just start making the payments. Your company makes payments to the lessor, so much per year. And there's no down payment the way you would do if you purchased it and got a loan at a bank. Then you would have to make a down payment and then make payments. Protection against obsolescence. This is one of the main reasons that companies will lease IT equipment, because IT equipment gets obsolete so quickly. And so if you lease it, if it gets obsolete, you just turn it in, you're done with it, and you lease the newest stuff that isn't obsolete. There's flexibility because it is a contract. So it's between you and the lessor, and you can have all kinds of flexibility between the two of you as to how things are set up. There's less costly financing. If you purchase something and you finance it through a bank, the bank is going to charge you a higher interest because that's how they make their money. And the seller wants to make their profit. If you lease it directly from the seller, they still want to make their same profit on the thing, but they're not as concerned about making a profit on the financing part. So they'll charge you less interest than a bank would. There can be tax advantages and there can be off-balance sheet financing, particularly if we're talking about an operating lease. Many times, if it is a capital lease, it means we're going to put an asset onto the asset side of the balance sheet, but there's going to be a matching liability on the liabilities. This is the same as if you purchased it and you financed it through a bank. You would have an asset added onto the asset side of the balance sheet, but the liability of the note payable to the bank would be on the balance sheet liability section. Now, if you have an operating lease, then in that case, it's just rent expense, goes on the income statement, nothing is going on the balance sheet. So if your company had a bunch of liabilities already clogging up its liability section of the balance sheet, they would be very interested in having something they're leasing that isn't going to show up as a liability. Here we take a look at the capital lease versus operating lease. These are the two main kinds of leases. To capitalize something, we've talked about this in other chapters, means that you're going to debit or increase an asset. Okay, so that a capital lease means that you're transferring substantially all of the benefits and risks of property ownership, provided the lease is non-cancelable. Okay, so it's almost like purchasing something and just financing it through the bank. You're getting the same types of rights and responsibilities that if you did that. If the lease is non-cancelable, that means that you can't just cancel it out because you decide you want to stop using this thing, and then you just want to cancel out the lease and turn it in, okay? It has to be non-cancelable for this to be a capital lease. If it is a capital lease, then we are going to debit the asset, capitalize the asset, and then we'll also have a liability, a capital lease liability that's going to go on the balance sheet. It'll be the same as if we purchased it and had financing. Now, if the lease does not transfer substantially all the benefits and risks of ownership, and it's just you're just renting it, and you can turn it back in, and you have no rights of ownership at all, then that would be an operating lease, and it's just like rent expense. It goes on the income statement, and nothing is going on the balance sheet. As far as the accounting goes, if the lessee capitalizes a lease, again, the lessee records an asset and a liability. And so you see down at the bottom, delta is the lessee, and you see that they're debiting leased equipment, which is an asset, and they're crediting lease liability, which is a liability. Also, even though Delta technically doesn't own the asset, if it's considered a capital lease, by all rights, it's like they own it. And so they're going to also record depreciation on that asset. They're going to record it as an asset, and they're going to record depreciation at the end of their fiscal years, an adjusting entry, just like they would on the assets that they owned. Okay? When they make a payment on the lease liability, it'll be just like making a payment on a note payable. Part of the payment will be considered interest, and part of the payment will be considered principal. Okay, there are 4 primary criteria for it to be a capital lease. And so, number 1, the lease transfers ownership of the property to the lessee. Number 2, the lease contains a bargain purchase option. Number 3, the lease term is equal to 75% or more the estimated economic or useful life of the property. And number 4, the present value of the minimum lease payments equals or exceed 90% of the fair value of the property. If any one of these criteria is met, then boom, it's automatically a capital lease. And we'll go through these in more detail in a minute. If none of those 4 tests are met, then boom, it's an operating lease. And so here's a flow chart that shows you the same thing. Okay, you've got a lease agreement. You're going to first ask the first question: is there a transfer of ownership by the end of the lease? Okay, if there is, then boom, it's a capital lease. If there's not, then we go on to question 2. Is there a bargain purchase option? If there is, boom, it's a capital lease. If not, we go on to question 3. Is the lease term more than 3/4 of the useful life? If yes, it's a capital lease. If no, we go on to question 4. Is the present value of the payments equal or more than 90% of the fair market value of the asset? If it's yes, then boom, we have a capital lease. If no, then we've said no to all 4 criteria, then it is an operating lease. All right, so let's take a look at these criteria in more detail. The first one is transfer of ownership. If the lease transfers ownership of the asset to the lessee, typically at the end of the lease, it is a capital lease. So if the lessee leases a piece of equipment say for 4 years, and right in the lease contract, it says at the end of the 4 years, as long as they've made all their payments, then they get to keep the asset. Okay, that's a transfer of ownership. In that case, boom, it is a capital lease. Now, there's also a thing called a bargain purchase option. And here is where there is the option, the choice, that at the end of the lease, you can, even though it doesn't transfer ownership automatically, you can purchase that thing for a really cheap price. And it's cheap enough that the reasonable person or company would definitely do it. So if you have a piece of equipment of $5,000 and you pay $1,000 for 3 years, so far you've paid $3,000 out of the $5,000, and it lets you purchase that for $100 at the end of 3 years, well, boom, that's a bargain purchase option. And if there's something like that in the contract, then it's automatically assumed that you are going to take that option, and therefore the transfer of ownership will happen, and it will be a capital lease. The 75% test, this is where they're taking a look at the lease term and they're seeing if it's 75%, 3/4 of the economic or useful life. So let's say we had an asset, a piece of equipment whose useful life is considered to be 4 years. If the lease term, we're going to lease it in the contract for 3 years, then I take the lease term, which is 3, divided by the useful life, which is 4, 3/4 equals 75%, and I would say, boom, yes, this is a capital lease. Now, if the useful life was 4 years, but the lease contract is only for 2 years, then I would have 2 divided by 4, which is only 50%. That's less than 75%. So we would not pass this particular criteria. Now, as far as considering what is the lease term, if there's a bargain renewal option, that can extend the lease term. So if we take a look at this example, Home Depot leases Dell PCs for 2 years at a rental of $100 per month per computer. Okay, so when we just look at that, we say, oh, the lease term is 2 years. Okay. However, they also have in the contract that they can lease them for $10 a month per computer for an extra 2 years. Well, that's a real bargain. And so it's assumed that you're going to do that. And so the lease term is now 4 years. If the useful life of the computer was 4 years, then you would have 4 divided by 4, which is 100%, and this would definitely be a capital lease. Okay. The fourth criteria is the recovery of investment. If we added up the present value of all the lease payments, does that equal at least 90% of the fair market value on the date that we start the lease? So in other words, if we were to sell this piece of equipment for cash on day 1, okay, and we compare the present value at day 1 of all the lease payments, is the present value at least 90% of what you would sell that thing for cash? Okay, now the minimum lease payments do include the actual rental payment that we have to pay, any guaranteed residual value. What that is talking about is let's say you lease a piece of equipment and it's supposed to be worth $10,000 at the end of your lease value. In other words, if you damage it and ding it up and you way overuse it, then it's not going to be worth $10,000 and you're going to have to make up some of that money. If you lease a car, that can happen. Usually they'll tell you, oh, you can only do 12,000 miles a year on the car. And when you turn it in after the 2 or 3 years of the lease, and you got way more miles on it, you're going to have to pay. Okay, so that's what the guaranteed residual value is. There can be a penalty for failure to renew or extend the lease that would be added in, and if there's a bargain purchase option, that can be added in to these minimum lease payments that we're going to find the present value of. Now, we're going to use our time value of money techniques that we already learned how to do. We're going to calculate out the present value. Okay, now there's another thing we have to know about is executory costs. Executory costs can include things like insurance, maintenance, and taxes. If you lease a car instead of purchase one, you still have to pay the insurance on it. You still have to pay many types of maintenance, and you still have to pay personal property taxes to get your plate, etc. Okay, the lease company is not going to pay those things. And the same thing with other leases of equipment. Whoever is the lessee still has to pay these executory costs, and they are not included when we're doing that present value of the minimum lease payments. That does not include those executory costs. Those are on the side, and we have to exclude those. Now, sometimes those executory costs, the lessee just pays separate to a third party, like insurance. Maybe they pay the insurance to their own insurance company, okay, and they just give a proof that they have insurance to the lessor, okay. Other times, sometimes like personal property taxes, the lessor will actually pay those because technically they still own that asset. And so they may have to pay the taxes to their state, and then you just reimburse the lessor for those taxes. If that's the case, then you have to subtract that out of whatever your lease payment is before you calculate the present value. All right, this slide is talking about the interest rate that we're going to use when we calculate out the present value. The discount rate, also known as the interest rate, okay, to be used by the lessee when we're calculating the present value. And so we've done this with time value of money. We have to put in the interest rate. And the one that the lessee is going to use is their incremental borrowing rate. Well, their incremental borrowing rate means what rate would they have to pay to borrow money right now, given all their other loans are already in place. Typically, the more loans you have, then if you go in to get the next loan, they might charge you a higher interest rate because now you have all these extra loans, okay? So that incremental borrowing rate is what the lessee's going to use, unless if the lessee knows the implicit interest rate, means the implied interest rate computed by the lessor, and that implied interest rate is less than the lessee's incremental borrowing rate. Then the lessee must use the lessor's rate. So again, as I said earlier, the lessor is not as concerned about making a huge interest rate, and so they will typically have less of an interest rate than, say, the bank that the lessee would go to get a loan from. So if the lessee knows that rate that the lessor is using, and typically it is less, and typically the lessee knows it, then the lessee will use that lesser interest rate when they're calculating present value. We do use the effective interest method, just like we used with bonds, to calculate out the lease payment between how much is principal and how much is interest. And we're going to make an amortization schedule just like we did for bonds. All right, the asset and liability are recorded at whichever is lower, the present value of the minimum lease payments, which don't include the executory costs, or the fair market value of the leased asset. Whichever is lower, that's what they're going to record, both the asset and the liability. They'll debit the asset and credit the liability. Depreciation is also going to have to be taken by the lessee. The depreciation period they use is going to be typically the lease term. If, however, it does include a transfer of ownership or bargain purchase option, which is going to transfer ownership, then they would depreciate the asset over the useful life of the asset, not the lease term. So if the useful life is 4 years, but we're only leasing it for 3 years, and then we're going to do the bargain purchase option, and so we'll own it at the end of the 3 years. Well, in that case, we're going to go ahead and depreciate it over the 4-year useful life. But if we do not have a transfer of ownership, then we'll only depreciate it over the term of the lease, so in that case, the 3 years. All right, let's go through an entire example. And so here's a lot of facts here, and we'll read through this together. Caterpillar Financial Services Corp., a subsidiary of Caterpillar, and Sterling Construction Corp. Sign a lease agreement dated January 1st, 2014 that calls for Caterpillar to lease a front-end loader to Sterling beginning January 1st of 2014. The terms and provisions of the lease agreement and other pertinent data are as follows. The term of the lease is 5 years. The lease agreement is non-cancelable. If the lessee, Sterling, was able to cancel the lease, then automatically, we don't even need to go any farther, this would be an operating lease. However, it is non-cancelable, so that means we're going to have to go through the 4 criteria. Okay, and it requires equal rental payments of $25,981.62 at the beginning of each year. Now, when we were talking about bond stuff, we were talking about how, like the interest payments that the bond issuers had to pay was at the end of each period. And so we used an ordinary annuity table when we were calculating out the interest payments, the present value of the interest payments. Here with leases, typically a lease, just like possibly if you rent a house or an apartment, you typically have to pay lease payments at the beginning of each period. And so we call that the annuity due basis, and there's separate tables in your text for annuity due basis of present value. All right, next, the loader has a fair market value at the inception lease of $100,000. That means if we sold it on day 1 of the lease to somebody for cash, we would sell it for Caterpillar would sell it for $100,000. Okay, so that's the fair market value. The estimated economic life is 5 years, so the useful life of this equipment is 5 years, and there's no residual value, salvage value. Okay, Sterling pays all of the executory costs. So the lessee is paying all of the executory costs, and they're paying directly to third parties such as insurance companies, except for the property taxes, which are $2,000 a year. So Caterpillar is paying the $2,000 a year taxes to its state, and then Sterling has to reimburse Caterpillar that $2,000 a year. And that's included as part of the annual payments. So we set up above that the payment is $25,981.62. Well, out of that, $2,000 is for property taxes. So actually, the lease payment itself is $23,981.62. All right, going back to the facts, the lease contains no renewal options. So there can be a renewal option, there can be purchase options, but this has neither. There can also be bargain purchase options and bargain renewal options, and this doesn't have those either. Okay, the loader reverts to Caterpillar at the termination of the lease, so there's no transfer of ownership to Sterling. Sterling's incremental borrowing rate is 11% per year. So that's what they would have to pay if they went and got a loan. Sterling depreciates on a straight line basis similar equipment that it owns. Caterpillar sets the annual rental to earn a rate of return on its investment of 10% per year, and Sterling knows this. So when we go to calculate present value, we are going to use the 10% because number one, the lessor's rate is lower, and number two, the lessee knows what it is. Okay, so we will not use the 11%, we'll use the 10%. Now, when we're taking a look, the first step we have to do is say what kind of lease is this? Is it a capital lease or an operating lease? So is there transfer of ownership? No, there is not. Is there a bargain purchase option? No, there was no bargain purchase option. Is the lease term at least 75% of the useful life? No, the lease term is 5 years, and the useful life is 5 years. So 5 divided by 5 is 100%, which is more than 75%. So, yes, okay, we do pass that. Now, we could quit right here. It is automatically now a capital lease for the lessee. However, if we go ahead and take a look at the present value, if we calculate out the present value of the minimum lease payments, and that adds up, and we'll see that in the next screen, that will add up to $100,000. And the fair market value is $100,000. So $100,000 divided by $100,000 is 100%, which is more than 90%. So yes, it passes test 4, criteria 4, as well as criteria 3. So either one of these automatically makes it into a capital lease. Here is where we're going to calculate out the minimum lease payments. So we had the original payment, $25,981.62. And we had to subtract out the property taxes of $2,000. And that gives us the minimum lease payment of $23,981.62. Then we're going to look in our record, in our time value of money tables. And there's going to be a present value of an annuity due table. And we're going to look up the 10% because the lessor's rate was 10%, which is lower than the incremental borrowing rate of the lessee. and the lessee knows it. So we're going to use that lower 10%. And the number of periods is 5 years. So I equals 10%, N equals 5. We're looking in the table that's present value of an annuity due, and we would get 4.16986. We multiply that times our minimum lease payment, and that gives us the present value of those minimum lease payments of $100,000. So now that we know that it's going to be a capital lease, we need to do our journal entries. We need to set up the capital lease and the lease liability on day one. So we're going to debit the asset, leased equipment, $100,000, and we're going to credit lease liability, $100,000. We also have the very first day, remember the payments are made in the beginning of the period. So we're not waiting until the end of the year and then making the payment. The payment is made right now today, January 1st of 14, the first payment. Now, just like we had with bonds, when you're talking about interest on day one, okay, no time has passed. So there is no interest. The whole payment is going to principal. So we're going to debit property tax expense. That was the $2,000. And we're going to debit lease liability. The whole $23,981.62 is going on the principal. And we're going to credit cash for the $25,981.62 that's coming out of the checking account. So this is our first payment and setting up the asset and liability on the first day. Now we're also going to go ahead and make an amortization schedule. And this is like we did for our bonds. We're going to start over here to the right is our balance of the lease liability. Starts out by being the $100,000 and should end up being zero when we get done. Okay, so on the first day we stick in the balance, and then we're going to show our first payment on January 1st to 14th, which was $25,981. But $2,000 is coming out of executory costs. Okay, the interest on that first payment is zero. Okay, so the whole $23,981.62 lease payment is going against the principal. We take the previous balance, $100,000, minus the $23,981.62, and that gives us the balance that's still left to have to pay on the lease liability of $76,018.38. On the end of December 31st of 14, we have some adjusting entries. We learned extensively about adjusting entries in Accounting 201, and so we know that we have to do any accruals of interest, and we have to do depreciation. Okay, so where are we getting the accrual? Now we're paying tomorrow on January 1st of 15, we're going to make the payment. But right now on December 31st, I have to show how much interest expense, because the matching principle says we have to record expenses when they're incurred. So now a whole year's gone by, we have interest. So we're looking up at our amortization schedule. Okay, the payment that we're going to make tomorrow on January 1st of 15. Okay, we have interest of 10%. Okay, we take the previous balance, which is $76,018.38, times the 10%, which is $76,001.84. Okay, so that amount is our accrual of interest that is on December 31st. Now, we're not actually paying this in cash, so we're going to credit interest payable, the $76,001.84. We also have the depreciation to record on December 31st. we had $100,000 asset, and that the useful life or the lease term is 5 years, which happens to also be the useful life. And so 100,000 divided by 5 years is 20,000 a year for depreciation on a straight line basis. So we debit depreciation expense for 20,000 and we credit accumulated depreciation for 20,000. Here's the liability section of the balance sheet. Our current liabilities as of December 31st is the interest payable of the 7601.84, because by tomorrow we're paying that. Okay. The lease liability section is how much of the principal are we going to pay in the next 1 year. Now, where did that number come from? So we're going to go back, and we see that tomorrow we're going to pay 7601.84 in interest. And if I take the 23,981.62 payment minus the interest, I get the part that goes on the principal, 16,379.78. So that's due in the next 12 months. It's due tomorrow, actually. Okay. And the rest of the lease liability, if I take the previous balance, 76,018.38, minus the part that's going on the liability on the principal right now, 16,379.78, I get the balance is now 59,638.60. That balance is what's going to be due in more than 1 year. So that's long term. The 16,379 is due tomorrow, so that is in current liabilities. So here we have the 16,379.78 that's part of current liabilities, and the non-current liabilities, also known as long-term liabilities, is showing the 59,638.60. So this is very easy. Once you have that amortization schedule, you just pull the numbers straight off that schedule. Now here's the second payment, which is made on January 1st of 2015. And so again, we're going to use our amortization table and pull it right off of there. We have the property tax expense of $2,000 that we're debiting. That goes straight to the income statement. The interest payable of $7601.84. Now this doesn't say interest expense because we already recorded the expense on December 31st so that it could go on 2014's balance sheet and income statement. Okay, but the interest payable was that current liability. Well, we're paying it now, so we're decreasing that liability. We no longer are going to owe this because we're paying it today. We're debiting the lease liability itself for the part that goes on the principal, which is the 16,379.78. Okay, and we're going to credit cash for the total amount that's coming out of the checking account, 25,981.62. If by chance we have a lease that does not match any of the criteria or is non-cancelable, then we have an operating lease. In that case, it's very simple. Here we have an example. What if Sterling accounts for the lease as an operating lease? Let's just say that they didn't pass any of the criteria. Okay, then on January 1st of 2014, they would just simply debit rent expense for the whole $25,981. Notice there's no separating out the executory costs. Okay, and they would credit cash for $25,981.62, and they would have this exact same journal entry every year. Debit rent expense, which goes on the income statement, credit cash. There's no interest and principal part. There's no depreciation calculations. There's no amortization schedule. There's no asset. There's no liability. Just the total amount that we pay every year goes into rent expense or lease expense. In our next presentation, we'll take a look at the leases for the lessor.